There is a recurring pattern in financial history, one that has quietly erased the savings of millions over the last decade and a half. And the unsettling truth is that even in 2025, the legal structure for the same thing to happen in the United States is fully established. To understand the danger, look at the precedents. In 2018, citizens of Cyprus woke up to find banks closed. When the doors finally reopened, nearly half of all deposits above 100 yuan had vanished. Not stolen, not lost, legally seized by the government to stabilize collapsing banks. 2 years later, Greece imposed capital controls that allowed citizens to withdraw only $60 per day. Whatever money you had in the bank was effectively trapped, untouchable and unmovable, unusable. And in 2019, Lebanon froze a bravery account nationwide. Individuals with millions in savings were restricted to withdrawals of only $200 per week. Years later, those people still cannot freely access their own money. In each case, depositors discovered that their savings did not really belong to them once the system faltered. 3 countries, 3 economic crises, and 3 moments when governments used the same mechanism, not taxation, not inflation, but the direct legal authority to take or immobilize bank deposits. These episodes were not historic anomalies. They were test runs. And what should disturb you is that the United States already embedded this power into law with the 2010 Dodd-Frank Act. The law bans traditional bailouts and replaces them with something far more dangerous to ordinary people: bail-ins. When the next crisis hits, and financial cycles guarantee that one eventually will, your deposits will be the first buffer to absorb losses. Not taxpayer funds, not Federal Reserve rescue packages. Your money. Understanding this requires clarity on what a bail-in is and why it is a radical departure from past policy. When major banks collapsed in 2008, government stepped in to rescue them. Taxpayer money, printed liquidity, emergency credit lines, public funds were used to cover private failures. This triggered global outrage. Populations understood that the system was built on the promise of profits for banks and losses for the public. Politicians swore to fix it, and they did in a way that protected governments but exposed citizens. Under the new laws, no country wants to repeat the politically disastrous bailouts. The logic looks simple. If banks take irresponsible risks, they should bear the consequences. Shareholders should be wiped out. Bondholders should take losses. That seems fair. But here's the problem. Modern banks use enormous leverage. Their obligations often dwarf their equity. So once shareholders and bondholders are wiped out, the losses are still far greater than what the bank can absorb. That is where depositors come next in line. The money you think is safely stored in your account becomes the bank's survival capital, automatically converted into shares or written off entirely, overnight, without your permission, without warning. And this is not hypothetical. It has already happened. Cyprus in 2013 was the first full-scale demonstration. A tiny Mediterranean nation, but deeply integrated into the European financial system. Over the 2000s, Cyprus evolved into a global banking hub, attracting foreign capital from Russia, Europe, and beyond. Low taxes, secrecy laws, and Eurozone access turned it into a magnet for wealthy depositors. By 2020, its banking system had grown to 8 times the size of the national economy. This imbalance created fragility. When the banks bet heavily on Greek government bonds, drawn in by double-digit interest rates, their portfolios became dangerously exposed. And when Greece restructured its debt, The value of those bonds collapsed. Billions evaporated. Cypriot banks were insolvent, though no one wanted to admit it. By early 2013, denial was no longer an option. The two largest banks needed a massive recapitalization, about $10 billion. But Cyprus's entire GDP was only $18 billion. The government could not afford a bailout. They asked the UN and IMF for help, but received a blunt condition. Depositors would have to take the hit. Overnight, banks closed. ATMs stopped dispensing cash. Capital controls locked the country down. When the banks reopened almost 2 weeks later, large depositors discovered that nearly half of their balances had been confiscated to recapitalize the institutions that had mismanaged their funds. The lesson was clear. When a bank's survival is at stake, depositors become involuntary investors. 2 years later, Greece faced its own reckoning. Years of austerity, collapsing GDP, and political instability pushed the country to the edge of default. Citizens saw the warning signs and rushed to withdraw savings, triggering a bank run. In a matter of days, billions fled the banking system. The government's solution was swift and suffocating. Banks closed. Withdrawals were capped at $60 per day, and international transfers were halted. Businesses could not import goods. Families could not send money abroad. Entire supply chains froze. Greece did not seize deposits outright, but the effect was nearly identical. Money you cannot access is money you effectively no longer have. It becomes an illusion on a screen, a number without function. The psychological impact was enormous. Pensioners waited for hours in the heat to withdraw 120s per week. Businesses collapsed because they could not pay suppliers. The economy became cash only, and even cash itself became scarce. The controls lasted for years, and trust in Greek banks evaporated. To this day, many Greeks refuse to keep savings in domestic banks. Lebanon's crisis completed the trilogy. Its banking system was once considered one of the most stable in the Middle East. But by 2013, the government's long-term mismanagement and hidden insolvencies came to light. Banks froze accounts without warning. A millionaire and a schoolteacher were suddenly equal, both limited to withdrawals of a few $100s a month. Hyperinflation soon followed, wiping out the real value of deposits entirely. It was a slow-motion confiscation, hidden behind bureaucratic restrictions. These cases illustrate a profound truth. A modern financial system can take your money without technically taking it. All it must do is restrict access, impose controls, or convert deposits into capital during a crisis. And in every instance, the justification is the same: protecting the stability of the financial system. Stability for the system, instability for individuals. The United States, often assumed to be immune from such events, laid the legal groundwork in 2010. Most people still believe that FDIC insurance guarantees the safety of their deposits. They imagine that no matter what happens, the government will make them whole. But the FDIC fund is tiny compared to the size of the banking system. Bail-in authority exists precisely because traditional bailout tools are politically toxic and financially inadequate. The next time a major bank becomes insolvent, the mechanism won't be a bailout. It will be a bail-in. Depositors, ordinary Americans, will absorb losses to save the institution. And the most important lesson from Cyprus, Greece, and Lebanon is this: when a crisis hits, you won't receive a warning. The doors simply close. The ATM is shut down. The rules change overnight. And by the time the system reopens, The money you thought you controlled may no longer be yours. The lesson from Greece is stark. Even without an explicit bail-in, a government can trap your money through capital controls, rendering it practically worthless. You may still see the digits in your account, but your functional ownership disappears. And those restrictions, once imposed, can persist for years. Even so, some people comforted themselves with the belief that these events only happen in weak countries, small economies, politically unstable regions, nations already crippled by debt. But Lebanon shattered that illusion. It proved that even middle-income countries with seemingly stable banking systems can collapse in ways that leave depositors helpless. Lebanon's crisis, beginning in 2019 and still continuing today, may be the most brutal of all modern financial failures. For decades, Lebanon was praised as the Switzerland of the Middle East. Beirut was a thriving financial center. Lebanese banks were widely respected and trusted, especially by the diaspora. The Lebanese pound had been pegged at 1 to the dollar for more than 20 years, an eternity in emerging markets, and that stability created a sense of permanence that, in hindsight, was dangerously misleading. By 2019, the country's banking sector had ballooned to 4 times the size of its economy. On the surface, this looked like sophistication and maturity. Beneath the surface, it was a house of cards. The government had been running massive annual deficits, 10 to 15% of GDP, funded largely by domestic borrowing. Banks eagerly bought government bonds offering high yields of 8 to 12%, far above comparable international rates. They could pay these rates only because depositors, both Lebanese and foreign, poured dollars into the bank seeking attractive returns. Those dollars were then recycled into government lending. The entire system worked as long as new deposits flowed in, but it was not a financial sector. It was a sophisticated Ponzi scheme disguised as national policy. In 2019, the illusion cracked. International lenders stopped extending credit. Dollar reserves thinned. The government's ability to borrow evaporated. As political unrest intensified and new taxes were announced, public frustration exploded into mass protests. Quietly, bank runs began. People tried to withdraw their dollars, only to discover that the banks did not have them. The dollars had been lent to the government, and the government had already spent them. By late 2019, banks began limiting withdrawals informally, first 1,000 per week, then 200, then 100. By early 2020, many banks allowed only back to 100 per week. What made this especially cruel was that account statements still displayed the full balances. The numbers remained, but the money behind them no longer existed. It was a digital mirage. And 6 years later, the restrictions remain in place. Many depositors have effectively lost their life savings. Lebanon defaulted on its debt in 2020. The currency collapsed, and inflation devoured whatever purchasing power remained. Some depositors sued. Many lost in court. Others took matters into their own hands. Throughout 2021 and 2022, desperate customers stormed banks with weapons not to rob them, but to demand their own savings. Several hostage incidents occurred. In one widely publicized case, a man held a bank at gunpoint simply to withdraw $5,000 to pay for his father's medical care. Far from being condemned, he became a national symbol, a tragic hero in a system where every citizen was trapped. Lebanon teaches a brutal truth. Modern banking is built entirely on confidence. Once that confidence breaks, laws, courts, and institutions become irrelevant. A bank can simply refuse to return your money, and the government may lack the resources or the will to intervene. You are not a protected client. You are merely a creditor in line behind other creditors, and the bank's insolvency becomes your personal catastrophe. 3 different countries, 3 different mechanisms, but one identical result: depositors lost access to their savings. Cyprus used an official bail-in, seizing 47% of large deposits and converting them into near-worthless shares. Greece imposed strict capital controls that locked money inside the system, reducing functional access to only $60 per day. Lebanon enacted an informal, unlegislated freeze where the digits remained, but the dollars were gone, perhaps forever. In all 3 cases, the people who trusted their banks were wrong, and in all 3 cases, the actions were either legal or tolerated without consequence. No central banker went to prison. No politician faced meaningful accountability. The system took the money, preserved itself, and moved on. This brings us to the pattern, a 6-stage cycle that repeats with unnerving precision. One that the United States is now showing early signs of. Stage 1. The banking sector becomes too large. Cyprus had bank assets at 800 of GDP. Greece reached 300. Lebanon stood at 400%. When banks grow far larger than the national economy, no government can bail them out during a crisis. The numbers simply do not work. The United States shows a similar structure. The 6 largest banks hold more than $12 trillion in assets, about 40 CVU. See, deep concentrated in 6 institutions. If they fail simultaneously, the government cannot cover the losses. Stage 2. Banks make risky bets. Cyprus loaded up on Greek debt. Greek banks lent heavily to an insolvent government. Lebanon used deposits to maintain an unsustainable sovereign Ponzi scheme. The United States follows the same pattern. Banks are sitting on more than $500 billion in unrealized bond losses due to rising interest rates. Commercial real estate, especially office buildings, is collapsing in value. In 2023, Silicon Valley Bank, Signature Bank, and First Republic Bank collapsed in rapid succession. These were not isolated incidents. They were warnings. Stage 3. A crisis trigger exposes the fragile reality. In Cyprus, it was Greece's debt restructuring. In Greece, it was imminent default. In Lebanon, it was the depletion of foreign currency reserves. In the U.S., the trigger could be many things: a recession, a commercial real estate implosion, ballooning government deficits, geopolitical turmoil, or simply the pressure of higher interest rates. Once the trigger appears, the losses hidden in bank balance sheets become impossible to ignore. Stage 4. Bank runs begin. In all 3 international examples, depositors rush to withdraw funds at the first sign of danger. That instinct is rational. Banks only keep a small fraction of deposits available as cash, lending out the rest. Modern technology makes runs exponentially faster. Silicon Valley Bank saw $42 billion in withdrawal requests in a single day. In a world where money moves with a tap of a smartphone, panic spreads with viral speed. Stage 5. The government intervenes, but the intervention always comes at the expense of depositors. Cyprus imposed bail-ins. Greece imposed capital controls. Lebanon allowed an unofficial freeze. In the United States, the Dodd-Frank Act explicitly authorizes bail-ins. If a major bank becomes insolvent, the FDIC can convert deposits into equity to stabilize the institution. Your cash becomes stuck in a failing bank, not lost, but unusable, which is effectively the same. Stage 6. Years of lingering economic pain. Cyprus took years to recover. Greece has not fully recovered even today. Lebanon remains in humanitarian crisis. Once savings are destroyed and trust collapses, it can take generations for a society to rebuild confidence in its financial institutions. Without trust, credit evaporates, investment dries up, and economic stagnation becomes the norm. This is the pattern, and it never ends well for depositors. The United States has already moved through the first 4 stages of the pattern, and now sits firmly in stage 5. The next banking crisis is not some distant theoretical threat. It is forming right now beneath the surface, visible to anyone willing to look. The vulnerabilities are not subtle. They are structural, mathematical, and accelerating. The first vulnerability is the mountain of unrealized losses sitting on the balance sheets of Cyprus regional banks. When the Federal Reserve raised interest rates from near zero to over 5% in 2022 and 2023, bond prices collapsed. Banks, which hold trillions of dollars in long-dated bonds, suddenly found themselves with assets worth far less than they paid for them. Under accounting rules, these losses can be ignored as long as the bonds are held to maturity, but that protection collapses the moment depositors demand their money. When banks are forced to sell bonds to raise cash, the losses become real. Capital is wiped out. Insolvency follows. Silicon Valley Bank proved this in real time. $16 billion in unrealized losses, a rapid wave of withdrawals, forced sales, and then instant failure. And SVB was not an outlier. Dozens of regional banks are in the same fragile position. The second vulnerability is commercial real estate, a slow-motion disaster that is now impossible to hide. Office buildings across the country are worth 50% less than in 2022. Yet banks still hold loans based on 2019 valuations. With $3 trillion in commercial real estate loans on their books, the moment properties must be refinanced or sold at current values, losses will detonate across the banking system. New York Community Bank's near collapse in early 2024 was a preview, not an anomaly. Many regional banks are exposed in similar ways, and every refinancing cycle pushes them closer to the edge. The third vulnerability is the illusion of FDIC insurance. The FDIC insurance fund contains roughly $125 billion. Total insured deposits exceed $10 trillion. That is one tweet coverage. If just 2% of insured deposits need to be paid out, the fund is gone. And that is before considering the $18 trillion in total deposits, most of which is uninsured, because anything above $250,000 per account is not protected. Even insured deposits are only safe in a slow era. In a systemic event, the FDIC would have no choice but to borrow from the Treasury or the Federal Reserve, meaning money printing, meaning inflation. Either way, your savings evaporate through seizure or through devaluation. The outcome is the same. The fourth vulnerability is the speed of modern digital bank runs. In earlier eras, a bank run required physical lines, panic spreading through communities, and hours or days before collapse. Today, a single viral tweet can move billions. A depositor can transfer $50,000 from their phone in 30 seconds. Silicon Valley Bank saw $42 billion withdrawn in a single day. 25% of all its deposits, gone in 24 hours. No bank on earth can survive that. And because social media amplifies fear exponentially, one bank failure instantly cascades into runs at similar institutions. Contagion becomes inevitable, and the system has no brakes. The fifth vulnerability is the legal framework itself. The bail-in mechanism is not theoretical. It is explicitly written into law. Under Dodd-Frank, the FATF has full authority to resolve failing banks by converting deposits into equity. In a systemic crisis, your money can legally be transformed into shares of a failing institution, shares that may be worth pennies. So what happens when these vulnerabilities converge? The scenario is not difficult to imagine. By late 2025 or 20, suppose a recession takes hold. Unemployment rises. Corporate defaults increase. Commercial real estate losses accelerate. A major regional bank announces a massive write-down. Depositors panic and begin withdrawing funds. The bank collapses. The FDIC moves in, but the insurance fund cannot cover the full amount. Other banks with similar exposure begin to suffer runs. Within a week, 3 more institutions fail. The FDIC fund is nearly drained. Markets plunge. Credit markets freeze. The White House declares a financial emergency. Over a weekend, a series of extraordinary measures is announced. Withdrawals limited to $300 per day. Transfers capped. Outbound wire transfers temporarily suspended. And for deposits above $250,000 at failed banks, forced conversion into equity. Bail-ins goes into effect. You had $500,000 in an account. Half is insured. Half becomes bank shares, worth perhaps 20 cents on the dollar. This is not fiction. It has already happened 3 times in the last 12 years. Depositors in Cyprus discovered that their money was not money. It was collateral. Greece showed that capital controls can trap funds for years. Lebanon proved that banks can simply refuse to return deposits indefinitely and suffer no real consequences. And the United States has the legal and logistical capability to replicate all 3. The vulnerabilities are extreme. The warning signs are everywhere, and the historical pattern is unmistakable. Whether the crisis hits in 6 months, a year, or 2, the math points to one outcome. So what can you do? First, understand the truth. A bank deposit is not savings. It is an unsecured loan to the bank. If the bank fails, depositor becomes creditor. Creditors take losses. That is the hierarchy of insolvency. Second, avoid concentration risk. Do not keep more than $250,000 in any institution. Diversify your accounts. Diversify your banks. Diversify your exposure. Third, keep a portion of your wealth outside the banking system in physical cash. If withdrawal limits or capital controls appear, physical cash becomes your only accessible liquidity. Fourth, consider hard assets. Real estate, gold, anything that exists outside digital banking rails. These cannot be frozen, bailed in, or reclassified by regulators with a weekend announcement. Fifth, have a plan. Know in advance where you will move funds, which accounts you will prioritize, which assets you will shift into. When the crisis unfolds, you will not have time to think. Preparation is the only defense against speed. And sixth, understand who the system protects. The government will not protect you. It will protect the banks. It will protect the financial system. And if your deposits stand between the system and collapse, your deposits will be sacrificed. It happened in Cyprus, Greece, and Lebanon. It can happen in the United States. Legally, 3 times in 12 years, depositors believed their money was safe. 3 times, they learned they were wrong. The pattern is clear. The vulnerabilities are real. The law is ready, and history has already shown what comes next. The real question is not whether a crisis is coming. It is whether you will recognize the signs before your money is trapped. If this shifted your understanding of what lies ahead, subscribe. When the next banking crisis arrives and your deposits freeze or convert before your eyes, you will want to understand not just that it happened, but why? The answers are not. In the future. They are already etched in the past, and I will show you exactly where to look.